season is back.
This video is going to be everything you need to know about filing your taxes, and you can thank me when you're older. So, January through April 15th, right here, this is called tax season. And it runs from January 1st of the year to April 15th, and that is going to be the last day that you can file your taxes. So, remember, circle that date. Can't do it any later than that, or Uncle Sam is going to hunt you down and he will make sure he gets his money. So the first thing we need to answer is, what do you actually need to file your taxes? Like, you got to send in something, so what do you need to send in? We're going to break this down to four main things. First is going to be last year's tax filing statement. Then it's going to be your sources of income for the year. Third is going to be all your investment account statements. And the last thing you need is all the materials needed for your tax write-offs. So let's start with last year's tax filing statement. So if you're filing taxes for 2024, you're going to need your tax filing statement from the previous year. And so whoever you filed your taxes with in the previous year will send you this by mail or email, or sometimes both. And it shows two main things. The first is going to show how much money you made last year. And the second, of course, is going to show how much you paid in total taxes last year. Second thing you need is your sources of income for the year. And these are the two main forms that you're going to need, are the W-2 and 1099. So most people will just have maybe one W-2, but if you're working a bunch of different jobs for different companies, you might have a few of each. So you're going to need all of those if you have them. So remember, a W-2 is a form from your employer, and they're going to send you one every year during tax season, and it states your income for the year, and it also states how much the company has been withholding from your paycheck for taxes. 1099 is going to show non-employment income. And so again, the difference is that that's income earned by freelance or contract work. You're not technically an employee of that company. And unlike a W-2, no money is withheld for taxes from these 1099. So you're always going to remember that you'll probably have to pay more taxes during tax season if you're using 1099s. So those are the two main sources of income forms that people will need. And now let's go to the third thing, investment account statements. So any investment accounts you have, whether it's E-Trade, Acorns, Robinhood, Coinbase, Morgan Stanley, there's hundreds of these different types of accounts, but you need to include all of them when you are filing. So what they're going to do is they'll send you something like this, and it's going to have a recap of your 2023 investment year, and it's going to show your capital gains and losses for the year. It's going to show extra dividend income for the year. So if you have stocks that pay dividends, it will count that. And it will also show any extra interest income you made for the year. You might need to pay taxes on some of that, so that's why you need to include it for your tax filing. So let's move on to the last thing you'll need when filing your taxes, and that's going to be your tax write-off materials. And so what a tax write-off really is going to be anything that you can use to decrease your taxable income. So not the income you made for the year, but the income you are taxed on. So you can reduce the amount you pay in taxes by doing this. So let's say you have your total income for the year, and after you count in your W-2s, all your 1099s, and all your investment accounts, and let's say all of that adds up, and you made $70,000 for the year when adding in all of those. And so right now you're being taxed as if you made $70,000. However, there's some things called tax write-offs or deductions that you can use to actually decrease this amount, so you actually pay less in taxes. So stuff like home mortgage interest, if you made a bunch of charitable donations, extra work expenses, capital losses. So if your investment accounts lost money, you can use those as tax write-offs. And there's a whole list of stuff that you can use for tax write-offs. And these are just a few examples. But let's say you add all of those up and you found $15,000 of tax write-offs. So that's going to actually be your taxable income for the years when you take your total income minus your tax write-off. So $70,000 minus $15,000. And so that is going to be your taxable income for the year. So you are taxed on all taxes like you made $55,000 for the year and not $70,000. And so right there, that list there is going to be called itemized deductions. But there's also something that you can use called the standard deduction. And the standard deduction is an automatic tax write-off that actually everybody gets to use. And it differs a little bit based off age and how you file your tax filing status. But between a standard deduction and itemized deductions, you have to only pick one, which is you're going to use for your tax write-offs. And you should always just go with the one that is more. So if you look at your standard deduction, it's more than all your itemized deductions, then use this as your tax write-off. However, if your itemized deductions end up being more, then use that as your tax write-offs. Because yes, it would be nice if you could use both, but at the end of the day, you have to pick either an itemized deduction or standard deduction for your tax write-offs. So let's now go over the 4 ways to file, or the filing statuses, and let's just quickly cover these. And so you have single head of household, married filing jointly, and married filing separately. So when you're single, that means you're filing your taxes for just yourself and you don't have any dependents, so no kids or people you're taking care of. And then if you're single head of household, you're also filing for yourself, but this means you actually do have dependents like kids or just somebody you're taking care of counts as a dependent. When you're married filing jointly, that means you're legally married and you are actually filing together as a couple. So both of your incomes on the tax sheet look like just one total combined income. Then there's married filing separately, and that's when you're legally married, but you both file your taxes independently. And that means your incomes count as 2 separate incomes, not one combined income. So now let's move on to the very last thing. How do you actually literally file your taxes? So there's really 3 ways. The first is that you can file them on your own using a 1040 tax form you can get from the IRS. Second is you can file them on your own using an online tax filing software service. And the top ones are Free Tax USA is the government's version. Then there's Intuit TurboTax, and H&R Block also has one. There's a few others, but those are the most common. And the third way is that you can file them with a paid certified tax preparer, so like a tax accountant who does them for you. And so one thing to note is that I would not recommend doing the first one. There is just too many ways to mess up on a 1040. There's too many things that you can miss. And so I strongly recommend when filing your taxes either going with a tax software service or filing them with a certified tax preparer, because both are actually cheap enough that it can totally offset the amount if you made a big error trying to do it on your own on a 1040, because the tax software services usually range from free to about $200 is the most you would pay using one of these. And then a certified tax preparer ranges from about $150 to $200 for just your average person. And again, that seems like a lot, but in comparison to how much you might have to owe if you do something wrong on your own, that's a small price to pay to make sure it's done right. So we're almost to the end here, and after all of that whole process, you find out if you get a refund or if you owe the government. And so you get a refund if you initially overpaid based on your taxable income. So the government actually owes you back money because you overpaid on your taxes. And if you owe the government, that means you actually initially underpaid based on your taxable income. So you actually still owe the government some of that tax money. So that is everything that you need to know about filing your taxes. Take it easy.
Take it easy.